I mean, the biggest mistake is getting sucked into a proprietary deal. What do I mean by a proprietary deal? I just mean a supplier, a partner, a competitor flatters you and says nice things about your business and your role as the founder. And we're easily seduced by that. And what M&A professionals refer to as a proprietary deal, meaning that you're negotiating with one person. And when you do that, lots of things go terribly.
Welcome back to another episode of the Built to Finish podcast. Today's guest has fundamentally changed the way entrepreneurs think about building a business. For decades, founders have been taught how to grow revenue, hire employees, and increase profits. But very few have been taught how to build a company that someone else would actually want to buy. Our guest changed that conversation. He is the best-selling author of Built to Sell, The Automatic Customer, and The Art of Selling Your Business. Books that have become required reading for entrepreneurs prepared to scale, create recurring revenue, and ultimately build transferable value. He's also the founder of the Value Builder System, a platform used by more than 80,000 business owners and advisors to understand, grow, and realize the value of their companies. John Warrillow, welcome to the show.
Thanks for having me, Stephen.
No, it's a pleasure. I love speaking with like-minded individuals, and thank you very much for building the value builder system, which we'll get into in a couple of minutes here.
Sounds good. Well, it's great to have you as a partner, and looking forward to the conversation.
Excellent. So Built to Sell completely changed how entrepreneurs think about their companies. What inspired you to write it?
Well, it was a conversation I had with a guy named Perry Mealy. So I go back to 20 years ago now. I had a market intelligence business. We did custom market research, and I built that business up to maybe $6 million in revenue, $1.5 million in profit. It's good, profitable business, lots of like household names on the client list. And I thought I wanted to sell it. So I went to see this guy named Perry Mealy. He's an M&A guy in Toronto. And I said, like, what do you think it's worth? I was kind of rubbing my hands together, waiting for the answer. And he said, well, before I can put a value on it, let me ask you two questions. I said, shoot. He said, okay, who does the research? And I'm like, I'm involved in some of it. And he's okay, well, who does the selling? And the blood was draining out of my face. But I'm like, I'm involved in a lot of that. And he says, like, John, there's nothing, I can't sell your company. There's nothing here. It's worthless. And Stephen, I tell you, like that, hearing that conversation, like it's 20 years later, it still brings kind of chills. It was
What a gut
demoralizing.
punch, right?
Yeah, gut punch is a good way to put it. But, I left that meeting and really was determined to kind of change the way I ran the company. And so we put in a subscription model. I got out of doing the selling. I got people doing the research. Ultimately, it was acquired by Gartner Group, which is a big New York Stock Exchange listed company. So like it had a happy ending, but it has really, I think, inspired me. It has really kind of galvanized me around this idea that what most business owners think drives value, in other words, revenue and profit, are related to value, but not necessarily the whole story. And I think everything we've sort of done from the books to the system, has some, in some ways, kind of the origin story goes back to that conversation with Perry all those years ago.
No, that's great. Well, thank you for putting that out there. I'm sure it's influenced thousands, if not tens of thousands of founders to think differently about their business.
Well, as you say, it was a gut punch for sure. But you've done, you've got into this business of helping entrepreneurs because you've sold an IT tech company. So like, what was your inspiration?
The inspiration for advisory work?
Mm-hmm.
You know what? I really wanted to, pay it forward in the entrepreneurial community. I've done, a lot of things right, and I've done even more things wrong. And it's become so rewarding to help founders avoid, some of the pitfalls that I went through. And even before selling my company, I was a member of this organization called the CEO Project, which is a CEO peer group. It's kind of like a Vistage, but it's a more sophisticated version of Vistage. And I won't go into all the competitive differentiators and turn this into a sales pitch. But what I like best about my experience there, not only did I get phenomenal advice from the peers that were in my group, I enjoyed giving them advice on their issues and their challenges and their opportunities, even more than I enjoyed receiving feedback on my own. So after I sold my business, I felt that that was, the right thing to do was to, give back to the entrepreneurial community and help them along their exit journey.
Well, I'm glad you did. It's interesting. There's something to be said from learning from someone who's been there and done that. My kid is a big ski racer, downhill ski racer, and there's something about downhill ski racing,
Hmm.
which is a combination of athleticism and, courage and risk,
Yep.
willingness to take risks. And so when he stopped racing, he started coaching. And I noticed that almost all the coaches were former racers. There was no technical experts. There were no sort of outside people. It's like, no, if we're going to teach somebody how to race down like an ice block, we're going to basically, engage or hire people who have done that. And I think, it speaks to the benefit that I think you bring to the conversations you have with owners, because there's very few people who've done what you've done, right? Like built and scaled a tech company. That makes you a great advisor, and I'm sure your clients are lucky. So yeah, I'm a big fan of learning from people who've done it, if that makes sense.
Yeah, no, that makes a ton of sense. And I say this all the time. I'm like, it doesn't have to be me. There's a million and one of us out there, right? Founders that are doing advisory work. And people say, like, why you versus I'm a really good accountant or a good attorney or a good investment banker? I'm like, well, those are very necessary components and partners, throughout the journey, but none of them have been in your shoes, being in the founder's shoes. So I'm not saying that a project with me won't involve a lawyer. It definitely will. It will involve accountants. It will eventually involve investment bankers and other partners that are going to be necessary. But you want a fellow founder attached at the hip to your success. That's really
Well,
important.
yeah, I think that's right. And I, in my experience, that's almost as much emotional support as it is intellectual support these days, because the process of actually building a company to sell, I think, and I'd be curious to know your perspective. I think there's a lot of an emotion associated with it, because for a lot of founders, when they realize what's involved in taking their business from where it is today to where they want it to be, a sellable asset, there's some big dramatic changes they need to make. And they can often impact employees. And oftentimes they feel like, they're very lonely in those decisions. I can remember, again, this goes back a long time ago, but that company, the market intelligence business I built, I had a CEO in charge. CEO is probably too grandiose a title, kind of a general manager who was doing a lot of the work.
Mhm.
And she was incentivized by EBITDA. And I came home from my meeting with Perry saying, like, we're gonna change this whole business, and we're gonna kind of create a subscription company, and we're gonna hire these people, and we're gonna do all this stuff. And she was resistant to it. And I'm like, but this is the best thing for the business, and it's great, and blah, blah, blah. And, years later, I realized, I had made a fundamental flaw, which was I had structured her compensation to short-term goals like EBITDA as opposed to the long-term benefit of the company. Long story short, that relationship ended in turmoil. And I think I look back on it now, and I think I was at least half of the problem. But during that time, it was very lonely. Like the one person I had in the past relied on and collaborated with, it was a shoulder to cry on, if you could use that term. She was now, like, we were now at odds. And so it was a very emotionally difficult time for me. And I think a lot of founders, you become sort of, because if you're the majority shareholder, you're the one who stands to gain from the changes you're about to make, but your
No,
employees may not
100%.
benefit,
It's very lonely at the top, and the more you grow, the lonelier it becomes, and the less people you have around you that you can actually rely on and trust with some pretty complicated decisions. And obviously, selling the business is the biggest one.
Agreed 100%.
So can you quickly rattle off the 8 drivers of value that is basically the foundation for the value builder system?
Yeah, I mean, I could touch on a few of them for sure. At the end of the day, the theme of Value Builder and everything that we have done at Built to Sell and so forth is this idea fundamentally that for your business to be valuable, for it to be able to grow beyond you and not be a bottleneck, not exist as a bottleneck, you have to structure it so that it can live without you. That sounds like a very easy idea. It's actually incredibly complicated.
Yep, easier
It,
said than
it
done for sure.
yeah, yeah. So one of the drivers we look at is the degree to which you have what's called monopoly control, meaning you have one thing that you do better than anybody else. Warren Buffett was famous for investing in companies with a deep and wide competitive moat. It meant that they had pricing authority, and that created a kind of a flywheel. But what it doesn't capture, but I think is equally important, is the fact that when you focus on one thing, you're able to start scaling beyond you, because now every new product or every new thing you cross sell, it grows complexity exponentially, not linearly. And so the best companies, the most valuable companies, the ones that scale without the owner, tend to do fewer things and sell them to more people. The least valuable companies do the opposite, right? They do lots of things and sell them to a few people. The most valuable are doing a few things, selling them to lots of people. So that's kind of one, and it kind of creates, I think, a little bit of a domino effect when you start to zero in on that kind of one thing and build a team that can execute that one thing. You start to create that kind of domino effect. It's oftentimes the precursor to another one of the drivers in Value Builder, and one of the things we look at, which is recurring revenue. Recurring revenue being so valuable to acquirers because they can view into the future. And Stephen, I don't need to tell you this, but when an acquirer looks at a business, they look at it in the same way that we would look at any investment. And we say, how durable is this investment? Like, is this a huge risk that I'm about to take, or can I feel confident that the profits are going to continue? And the more recurring revenue you have, the more confident an acquirer is going to be to make an investment in your company. And those two things are oftentimes interlinked, meaning you start by figuring out what the one thing is, and then you figure out, okay, well, who needs that on a recurring basis? Something that we could build a service contract around, or some sort of subscription around. Those are a couple of the big ones that start the process of building value. And again, I don't need to tell you all these, because these are things that you've been preaching about and including
Yeah,
with
I
your
mean, Tom,
conversations with clients.
talk about a gut punch. I mean, the lack of recurring revenue was what I'm not saying it caught up to us, but we got to the point where I grew my company to over $40 million a year in revenue, and we grew for almost every single year during our 26-year history. But we had less
Congrats.
than 10% recurring revenue, which was painful, right? Starting every January 1st, knowing that you have to go and kill over $30 million dollars of business was a tough pill to swallow, but we did it. But boy, I must say that our multiple when it came time to the exit definitely hurt because of the lack of recurring revenue. I'm not complaining in any way, shape, or form. It was a great journey, a wonderful ending, but it could have been significantly better had we had more recurring revenue.
Yeah, and it's not just software. Like, Stephen, you're obviously a great example of that. We've seen it in virtually every industry right now. Wealth management practices, as an example, are getting really good multiples. Why? Because they get paid 1% of assets under management. Most clients only move their money from financial advisor A to financial advisor B every 10 years. So, like, once you've got them as a client, you can sort of expect that revenue to continue. And so they're getting, mid double digit, 14, 15, 16 times EBITDA if it's a really well-run wealth management practice. So it's very common to see double-digit multiples when there's really high quality, recurring revenue. By contrast, if it's transactional revenue, to your point, you woke up every January 1st, you get like, how do I go replicate this, that I generate $30 million of business? Like, that's a tough pill to swallow. And so acquirers feel the same way. So again, I think it's like, Stephen, one of the things that I talk a lot about is this idea that most founders think of themselves as the CEO of their business, right? Like their job is to grow revenue and grow profit. And while I think those things are important, obviously, I also encourage founders, CEOs to kind of put on the role of, I'm the parent of my business. What do I mean by that? I mean, if you think about most parents, they may want their kid to be some famous entrepreneur, some famous scientist, or become a doctor. But for most of us, our biggest wish is that our kids become independent adults and have happy, successful lives. We don't necessarily need them to be the president or the whatever. Like they're just, we want them to be independent. And I think if more founders thought, my job as a parent of this business is, over time, right now it needs me to do everything and I need to like hold its hand as it crosses the street. But over time, my goal is that this business goes off into the world and becomes an independent functioning adult, and it doesn't need me anymore. And for those of us who are parents, I think it's an interesting analogy, because like it changes the way you approach something. Everything doesn't have to be driving to a quarterly profit goal or a revenue goal. If it's a longer term play, you can start to make different decisions. And so I encourage people to think about being a parent of a business.
No, I love that analogy. I love that analogy. And that's so true. Instead of continuously focusing in thinking your responsibility, like you said, is to grow sales and to grow profitability. Your real responsibility is to grow your team so that they can go and do that. And if you do that well, then the business will be less dependent on you.
Yeah, and it's tricky for founders to stick handle the whole like, do I give them equity? Do I give them options? Do I, how do I incentivize them to think like owners? Like, what did you guys do in your software company? Did you have partners? Did you give people equity? Like, how did you sort of
Yeah,
incentivize?
we had a stock option plan in place, and 10% of the company's equity was distributed across all of the employees. Actually, it wasn't until like the last final years that we stopped granting stock options, unless they were senior executives. But for almost from the very beginning, we had a stock option plan in place, and we had a share the wealth type mentality. When the company did well, everybody did well from a bonus perspective, and then obviously at the end with cashing in their stock options.
Anything you'd change about the way you structured the stock option plan if you could do it over again?
I would give out less.
Mm,
It was
yeah,
interesting. We thought because we were in the IT space, we thought stock options were a necessary evil from an ownership perspective, and
yeah.
obviously, for the more senior the person was, the more they would expect it as part of their compensation. But we felt that it was it should have been given out to everybody from the get go. And I think that, do I regret doing it? No, but we could have got away with giving a little bit less.
Yeah, I think this is such an interesting conversation for founders to stick handle. Here's what I've seen. In some extent, experienced firsthand. In the early days of a business, you want, I think, to go through the journey with partners. It's a very natural inclination to want people to share the journey with, and sometimes that causes people to like, do, if it's three partners, they each have a third of the business and they plow on. And sometimes, and there are lots of examples of multi-founder businesses being successful, and there's statistics showing they're more successful. That being said, I think for a lot of employees, they're not entrepreneurs, right? Like if they were an entrepreneur,
Right.
they would become one. And so
Exactly.
they want a paycheck. They want, they don't want to think about it. And they certainly don't want to take a haircut on their, compensation in return for some future potential goal down the road. And so, I think sometimes we overuse stock options, to your point, and give them to people who aren't really asking for them or aren't comfortable with what they mean, or
Right.
don't value them as much as they should. So it's a delicate balance. I don't know what the right answer is. We've done a bunch of different things, and I'm not sure I have all the right answers on
No,
that, but
you're right. I mean, it's a very complicated topic, and there probably isn't any right answer. There's a whole bunch of things that people need to be considering. Hey everyone, just a quick reminder that the Built to Finish podcast is brought to you by Accresis. Accresis have helped over 30 founders generate over $1 billion in wealth via strategic acquisitions or investor recapitalizations. If you're the owner of a middle market company and want to explore what a potential exit will look like for you so that you can finally realize the value of what you've been working so hard on, please do contact Accresis via the website accresis.com or hit me up on LinkedIn for more information at Stephen Pivnik. Now, back to the show.
yeah, but to go back to a value builder driver, you asked about the drivers. Another one is called hub and spoke, which is the degree to which the center of your business, and if every decision runs through you, not surprisingly, the value of your business gets compromised. But the quid pro quo of that, or the other side of that coin, is to try to get your employees to act like owners. Because if they act like owners, that means you can personally step away. And again, that's where trying to get them to act like owners, sometimes you have to make them owners to actually feel that way. There's other techniques, but sometimes it just comes.
Agreed. So besides hub and spoke and having like a high degree of owner dependency, what have you found is the next biggest mistake founders make it's finally time to sell their company?
I mean, the biggest mistake is getting sucked morphed into a proprietary deal. What do I mean by a proprietary deal? I just mean a supplier, a partner, a competitor flatters you and says nice things about your business and your role as the founder, and we're easily seduced by that. And what M&A professionals refer to as a proprietary deal, meaning that you're negotiating with one person. And when you do that, lots of things go terribly wrong. The first is that there's no competitive tension in the deal, meaning the acquirer has no motivation to strike a deal. They are, in fact, motivated to do the opposite, to protract and delay and obfuscate the length of the transaction extends on. The longer the transaction, the less leverage you have as the founder,
Yeah,
the more likely they are.
time kills all deals.
Time kills all deals. The more likely they are to retrade, which means that you accept the price at the LOI stage, and then they give you a haircut at the actual share purchase agreement stage. But again, it happens very naturally. Usually you just get approached by someone that you respect in the industry. They take you to lunch or they ask you for a Zoom call and they flatter you. And they say, maybe we should put an NDA in place and talk about a partnership. And then a partnership sounds like great. And then they say, well, while we're partnering, like maybe we should, have you ever thought about maybe being maybe we should think about like a merger where, and it's not a merger, they're buying you.
Right.
and then the merger becomes an LOI. And then all of a sudden you're negotiating with nobody other than one buyer. And so that's probably the biggest mistake we see founders making is getting lured, I would say, into a prop deal.
Yeah. And I think because of how flattering these situations are, my personal advice would be there's nothing wrong with telling the person on the other side saying, you know what, I'm super flattered by this, and I'm really interested as well, but I'm going to hire an investment banker to make sure that I'm getting the best deal possible. And if they're professionals, they shouldn't be afraid of going into that type of process.
Yeah, I think that's right. I think there's also a benefit to the buyer to have, if you hire your own M&A professional, because that M&A professional is going to create a structured process. Like they've seen the movie before. They know the kind of forms, they know what the lawyers need. I mean, they do run a professional process. The one caveat I would say, and I don't know if you would agree, Stephen, but I think there is an element of wanting to make it look like you're not shopping your company to everybody under the sun. The buyer still does need to feel, I think, like they've got some proprietary lanes, some advantage, some unique access to this company. So I think it would be a mistake to take a partnership and say, okay, we're going to shop it to 500, private equity groups. That's probably a mistake. Whereas, I think a good M&A professional would say to that potential buyer, look, we're really thrilled that you're interested and I think you'd be a great fit. There are 2 or 3 other companies that have expressed interest. So we're going to kind of run a process and make sure everybody's got all the information they need. So you're not saying 500 other buyers, you're saying, 2 or 3 or a handful or, half dozen or whatever. It's just optics, but I think it makes the buyer feel like, okay, I'm not being, put into some beauty contest here that I'm going to have to,
Yep. No, totally agree. That's great advice. Great advice.
Yeah.
So speaking about the selling process, how early should entrepreneurs begin preparing for an exit?
As early as possible. I know that sounds weird, but I think once you start to look at the decisions you're making through the lens of a buyer, I think it totally changes the decision making that you would do. Like, I'll give you an example. Years ago, I built a radio. I interviewed a guy who created a frozen yogurt brand. Okay. So he got this frozen yogurt into all the big grocery stores in the United States, Kroger and Safeway and all the others. And he'd always had this dream of having stores like Ben & Jerry's had distribution, right? Like you can go into a Ben & Jerry's store in the United States and actually, get the ice cream from Ben. So he had the same dream. So he had this brand. He was in Kroger's, but he's like, no, I want stores. I want temples to the brand. I want distribution. So sure enough, he goes out and starts to build stores. Well, stores is a totally different business than distributing through retail, right? Like you got to find real estate, you got to sign 10-year leases, you got to hire like junior hourly workers who are flighty and they don't show up for work. And it's like a big like disruptive change. So he had to raise money to do that. He sold equity in his business to sort of build out this retail chain and kind of lost a lot of equity in the process of sort of building out this chain. But eventually he went to sell this company. and he went to sell it as like an integrated company, and no one was interested. The only thing that people were interested in was the brand and the distribution at Kroger, which was the largest department store at the time.
Mhm.
He sold the company at a deep, deep, deep discount, and immediately the buyer bought it. They shut down all of the retail. So he'd spent 20 years building this entire distribution system, giving up equity, loans. I mean, just like chasing what no one would value in the eyes of the acquirer. So had he thought about his business from the standpoint of like, I'm building to sell, my goal is to one day sell, what will buyers find attractive? Like, I don't think there's no day too early to start thinking that way. Like I would even say from the very beginning, you want to be thinking like, who would want to buy this business and what decisions are we going to make today that will set us up for a decade down the road being attractive to an acquirer? So I know that's sort of a bit of a cop-out answer, but I would say sooner than later would be my,
No,
bet. I mean, what
I
what
couldn't
did you
agree
guys
more
do?
because you never know when an opportunity is going to present itself, right? And it may not just be a buyer. You may find yourself in the need for a new credit line or a new
Sure.
partnership can come about. There's a lot of things that'll bring you into due diligence or a mini version of due diligence. And if you're properly structured and firing on all the right cylinders, then you're going to have the best possible outcome for that relationship, with the bank, with a partner, or with an acquirer.
I agree 100%. And I think one of the other things that founders get wrong about selling their company is for a lot of them, they think it's like a 4x100 meter relay race. They're doing a 100-meter sprint down the track. They've got the baton and they pass the baton to the next runner and collapse on the sidelines because they basically given it all that they possibly have in that 100-meter sprint. Whereas in most transactions, there is going to be some sort of transition period where the founder needs to stay on and achieve certain milestones as under new ownership effectively. So
Hmm.
that could be in the form of an earnout. It could be in the form of, if it's a private equity buyer, an equity rollover where you're rolling some of your proceeds into being a shareholder. And those can last, 2, 3, or, years or longer in some cases, right? And so, if you say like, I want to be on the beach when I'm 60 or on the golf course by the time I'm 60, like it's not when you're 59 and a half do you start thinking about your exit. It's probably when you're 50. Do you want to start the process of preparing, knowing that you want to do a transaction when you're 55 and be on the beach when you're 60? Like that's probably too long a transition period, but it is much longer than people sort of anticipate. And the worst thing you can do is get to the final throes of a negotiation exhausted and then have nothing in the tank for an earnout or whatever the transition period the buyer wants to go through.
Agreed. Agreed. So after going through or studying, I should say, tens of thousands of businesses, through the Value Builder system, what surprised you the most?
It's a good question. One of the things that is somewhat surprising is that on the lower end of the market, and I know, Stephen, in your case, your clients are larger than this and for the most part, but if we take the kind of retail end of the small business market, so call it businesses with 3 million in revenue or under, something like that, the multiples paid for businesses like that really are very, very flat. They don't go up and down that much by industry. They don't change very much by economic cycle. It's not like larger businesses. They're more impacted by industry. They're more impacted by economic cycle. But in the very low end of the market, if you'll allow me to use that pejorative term, it doesn't change that much. And so,
Interesting.
yeah, I think that's somewhat counterintuitive for me, but we've seen it over and over again. As you mentioned in the outset, we've had 80,000 businesses go through Value Builder, and larger businesses, we see a lot of variance, but on the small end, it's very, they trade within a very fine band.
Yep. Okay. So we can't have any conversation between two tech guys without saying AI. How do you personally use AI, and what role is AI playing in Value Builder's future?
Yeah, it's a great question, and I'd maybe extend it as well to that of our advisors as well as the business owners they serve. Look, I think AI is obviously a very disruptive potentially incredible, potentially devastating technology, right? So, and it probably has all of those outcomes in different ways. How do I use it personally? I find I like it to brainstorm with. So my little hack is I'll say, ask me one question at a time to help me think through this problem. I don't want it to bombard me with 100 questions, but I like the back and forth is just asking me one question at a time. And I find that oftentimes it'll help me refine an idea, which is fun. I'll use it to copy edit a piece of writing. So I don't use it to write, but I will use, so I'll write something and have it, it'll copy edit it. So that's another, when it comes to Value Builder, there's an ad campaign that we have in the back pocket. I'm not sure if we're going to use it because it's basically, do you remember the old Salesforce ads where they had software and they had it like like the Ghostbusters like X'd out of the circle? So we have this ad campaign we may use at some point, which is basically artificial intelligence with the word artificial crossed out. Because what we've developed is an 80,000 data set, like 80,000 business owners have gone through this. And that's what gives it its meaning, and it's the benchmarks and the growth and the 8 drivers. Like it is a sort of a self-healing in that regard because it has got so much data behind it. There are a lot of coaches that are creating, their own assessments, but there's nothing there. It's just AI creating an assessment as opposed to data. And so that's something we've been thinking about. I think for advisors, if you're overusing AI, I think you are really going to get run over by a truck. Because if you think about it, by extension, a business owner can use Claude just as well as you can. And if all you're doing is feeding Claude, information and asking for, eventually business owners will say, you know what, I don't need to pay X $1,000 for you. I'm just going to. And so my advice, and I talked about this at the summit this year that we hold for all of our advisors, is I want you to, think it's 1984. Like I want you to go back to physically meeting with your clients. So if you're using Zoom, go physically meet with them. Create a boardroom, create a great workspace, have people come to your office, take them to a game, buy a box at the game. Take someone to lunch, go play golf. These are all like things from the 80s and 90s. But I think we're going back to a time when the winners are going to be the humans who could put, earlier in the conversation, I said at least 50% of this is kind of emotional support for entrepreneurs. That's delivered face to face, right? That's delivered in person. It's not delivered through zeros and ones and digits. So I think the winners are going to be the ones who get out of the office, get off Zoom and physically go meet people because it will be disruptive. It's going to be disruptive for sure. And I think every business is going to have some level of disruption. And I think, I don't know if you've seen this even in any of your client work, but I do think, late Gen Xers, younger boomers are just kind of throwing their hands up in the air right now and saying, enough, right? So let's go through, like, I went through 9/11, I went through the great financial crisis, I went through COVID, and now you're giving me AI? Like, I'm done. I'm out, right? I guess every generation feels like they had some, drama, tragedy to go through. And I get that, but I can see, and I've had conversations firsthand with a lot of, call it, 50 something entrepreneurs who are just like, I'm done. I can't stomach having to recreate my business again on the back of AI. So I think the time will tell, but I mean, what are your thoughts? I mean, you're a tech guy. How do you think it's going to impact the market?
First of all, I wholeheartedly agree with you about getting out of the office and out of Zoom. I travel all the time. I see each of my clients at least once a quarter, face to face, and nothing will replace, building a personal relationship. Also agree with you that just taking your client's data and spitting it through AI, your client will eventually learn how to do that themselves. They're probably already doing it.
Already doing it. Yeah.
Right. So even with the value builder output, I mean, I love the value builder output. It's really, really meaningful, insightful, and actionable. But my sales pitch on it is I'm going to read the value builder output and translate it to you through a founder's lens, having gone through the process multiple times myself. There's
Amazing.
nothing wrong in the output, but there's things that need to be prioritized, right? Because there's a lot of advice that the output provides, and now let's prioritize it based on my personal experience, and that's where I personally add value to Value Builder.
I love it. Yeah. And again, as we talked about, ski racers look to former ski racers to get coaching for, in your case, you've done this, right? You've built and sold a business. So I think you bringing that context to it is exactly right.
Thank you. Yep. Great. Well, John, thank you so much for sharing all of your knowledge and information. If folks want to contact you, what is the best way and to learn more about Value Builder?
Yeah. Valuebuilder.com is the best way, all roads lead there. So that's probably the best way. And I'm a LinkedIn guy. So on social, if I don't use social media with the exception of LinkedIn. So that's probably the best place to find.
Awesome. Well, thanks again for taking your time and being on the show today. Really appreciate it.
Thanks, Stephen. It was a treat.
And thank you, everybody, for tuning in to another episode of the Built to Finish podcast. If you've enjoyed this episode, please do like and subscribe. It helps the show tremendously, and I would greatly appreciate it. Thank you very much for tuning in, and until next time. That's a wrap for this episode of Built to Finish. Thank you for tuning in. For show notes and more details, head over to podcast.stephenpivnik.com. Special thank you to our sponsor, Accresis, offering tailored, high-impact advisory services that help founders get to their finish line with a strategic acquisition or majority investor recapitalization. Catch you next week.